Hello everyone, welcome to Tesla Daily News. Today is July 15th, Tuesday, and the following is the latest Tesla news. According to market data, Tesla shares opened around $399, traded between roughly $395 and just over $402, on volume close to 23 million shares, with the prior close near $395. Technically, the stock is testing recent resistance around the $400 zone and holding support in the mid-390s, suggesting consolidation after a strong run. Very short-term traders will note that buyers defended the prior close, while sellers stepped in above 400, so the next decisive move above or below this band could set the tone for the coming sessions. According to Clean Technica News, new analysis from Transport and Environment takes a close look at whether European Union tariffs on electric vehicles built in China are actually working, and Tesla features heavily in the story. The report finds that electric cars produced in China accounted for about 17% of the EU battery electric market in early 2026, down from a peak near 22% in 2024 when tariffs were first introduced. The big driver of that shift was not Chinese brands slowing down, but Western brands like Tesla, BMW, and Volvo moving production from China back into Europe. For Tesla investors, this is strategically important. Tesla had been using its Shanghai factory as a major export hub into Europe because of its world-class cost efficiency. Once the EU imposed anti-subsidy tariffs on Chinese-built EVs, the economics of shipping from China into Europe became less attractive, especially for a company that wants to preserve margins while still competing on price. The analysis shows that the share of Chinese-built battery electric imports coming from European manufacturers dropped from roughly 38% to about 23% between 2024 and early 2026, and Tesla's own slice of those imports fell from around 26% to 19%. That implies Tesla deliberately rebalanced its supply chain, favoring local European production from its Berlin-Brandenburg gigafactory and potentially other regional plants, rather than relying as heavily on Shanghai exports. From a stock and long-term strategy perspective, there are several key implications. First, shifting more production into the EU helps Tesla sidestep higher tariffs, protect its pricing power, and align with political expectations that EV jobs and value creation happen within Europe. Second, it positions Tesla as a relatively local player in one of the world's most important EV markets, strengthening relationships with regulators just as European policymakers are tightening carbon rules and pushing fleet electrification. At the same time, the report warns that Chinese brands themselves are not slowing down. Their imports into Europe continue to grow despite tariffs, and their electric models remain about 21% cheaper than European rivals on average. Companies like BYD are not just exporting cars, they are announcing plants inside Europe, shifting to plug-in hybrids where tariffs are lower, and increasingly targeting segments where value is critical. If you connect that to Tesla's position, it means the company must keep driving down costs and improving technology in Europe to stay competitive against very aggressive Chinese manufacturers. The analysis also highlights surging imports of Chinese batteries, which face almost no tariffs right now and have jumped roughly sevenfold from 2020 to 2025. European battery makers control less than a quarter of EU battery output and are under pressure. Transport and Environment argues that the EU should consider tariffs around 20% on Chinese batteries, projecting that such a move would raise the price of European-built battery electric vehicles by less than 3% on average. For Tesla, which is investing in its own battery production and increasingly in localized cell and pack factories near major vehicle plants, higher tariffs on imported Chinese batteries could actually be a competitive tailwind. They would likely narrow the cost advantage of some Chinese competitors who rely heavily on low-cost imported cells, while rewarding companies with integrated, regional supply chains. The report also stresses that if EU lawmakers weaken 2030 and 2035 carbon dioxide targets for new cars, European brands could electrify more slowly, leaving more room for Chinese brands to gain share. Under weaker standards, Chinese EV brands could capture up to 30% of the European market by 2035, versus about 15% under the current Commission proposal. For Tesla shareholders, the takeaway is that policy in Europe still matters enormously. Strong, predictable EV and emission standards, combined with targeted trade protection around batteries and heavily subsidized foreign competitors, can create a more favorable environment for Tesla's factories in Berlin and any future European investments. A looser regulatory regime with slower electrification could paradoxically hurt Tesla, because legacy manufacturers might delay their battery plans while Chinese rivals keep pushing, crowding the mid and low price segments and compressing margins across the board. According to Asia Today, Samsung Electronics is nearing production of Tesla's next-generation AI5 processor at its advanced chip plant in Taylor, Texas, marking an important milestone in Tesla's long-term artificial intelligence hardware roadmap. Industry sources cited by the report say a Samsung-made version of Tesla's AI5 chip has completed tape-out, which means the final physical design has been handed off to the foundry for prototype manufacturing. This does not yet mean full mass production, but for chip projects it is a critical step, essentially the point where the architecture, layout, and verification have matured to where you are ready to build real silicon for testing and refinement. The AI5 is expected to be produced using Samsung's cutting-edge 2nm gate-all-around process at the Taylor facility, with broader production ramping toward 2027. The background here is that Samsung previously disclosed a foundry contract worth about 22.7 trillion won, roughly $15 billion, for an unnamed customer. Elon Musk later confirmed that this massive order is tied to Tesla's next-generation artificial intelligence processors. Tesla is developing a full internal family of AI chips starting with AI4, now moving to AI5, and with AI6 and AI6.5 on the roadmap for use in autonomous driving, humanoid robots like Optimus, and data center training and inference. Industry reporting suggests that Tesla is splitting production of these chips between Samsung and Taiwan Semiconductor Manufacturing Company. Samsung already fabricates Tesla's AI4 on a 7nm process in Pyeongtaek, South Korea, and is expected to handle both the upgraded AI4 and later AI6 chips as well. TSMC is also believed to be building another version of AI5, which Musk referenced earlier this year. For Tesla investors, the significance is multi-layered. First, completing tape-out indicates Tesla's internal chip design team is executing at a high level, keeping the hardware roadmap moving. Vertical integration at the chip level is one of Tesla's core strategic differentiators. Instead of relying entirely on off-the-shelf GPUs or third-party automotive processors, Tesla is trying to optimize its entire stack from perception and planning algorithms down to the silicon to maximize performance per watt and per dollar. Second, using a state-of-the-art 2nm process could give Tesla powerful efficiency and performance advantages. Smaller process nodes typically mean more transistors in the same area, higher throughput, lower power consumption, or some combination of all three. In autonomous driving and robotics, where you want to run complex neural networks in real time under strict power and cost constraints, those gains can translate into better capability at lower cost, with less heat and smaller form factors. Third, tying AI chip production to the new Taylor, Texas, facility dovetails with U.S. industrial policy, including the CHIPS Act incentives, and positions Tesla to have a secure, domestic supply chain for some of its most sensitive and strategic components. That could reduce geopolitical risk tied to Asian foundry capacity and give Tesla leverage in negotiations with both Samsung and TSMC, because production is being shared between two top-tier suppliers. From a financial angle, the $15 billion contract underscores the scale of Tesla's planned AI infrastructure both in vehicles and in data centers powering its training clusters. Investors betting on Tesla's long-term value as an AI and robotics company, rather than purely as an automaker, can see AI5 as a bridge toward that vision. If AI5 and subsequent generations deliver the performance Tesla expects, it could accelerate progress in full self-driving, Optimus capabilities, and software-driven revenue streams that depend on massive compute. According to the Canberra Times, Tesla is addressing one of the biggest concerns of new electric vehicle buyers in Australia, future resale value and depreciation, particularly for the Model Y and Model 3. The company is rolling out guaranteed future value loans for these models, giving customers the ability to lock in a minimum future value at the time of purchase. Under this structure, part of the car's cost is deferred to the end of the term as a guaranteed residual value. That lowers the monthly repayments compared to a traditional loan, because you are not amortizing the entire purchase price over the term. At the end of the agreement, the customer can choose to pay the predetermined residual and keep the car, or simply hand the vehicle back and upgrade to a newer model, assuming the usual conditions are met, such as mileage and fair wear and tear. This kind of program is well known in broader auto finance. They resemble balloon loans or guaranteed future value plans many legacy automakers have used for years, but Tesla has historically taken a more simplified, cash purchase and straightforward finance approach. Introducing guaranteed future value in Australia signals that Tesla is now more willing to use financial products strategically to grow demand and manage customer perceptions around value retention. Electric vehicles, including Teslas, have suffered from higher depreciation rates in some markets due to rapid technological change, shifting subsidies, and aggressive price cuts. By offering a guaranteed floor on future value, Tesla is essentially absorbing part of that risk and signaling confidence in the enduring desirability of its cars. It reassures buyers that even if used EV prices fluctuate, their downside is limited. For the stock and for Tesla's competitive positioning, this can have several benefits. It makes monthly payments more affordable, bringing in customers who might otherwise choose a cheaper internal combustion vehicle or a lower-priced rival EV. It also anchors buyers within the Tesla ecosystem, because at the end of the term, many will simply roll into a new Tesla supporting recurring sales of refreshed models like the updated Model 3 and Model Y. The article notes that Tesla's finance partner Driva is facilitating the scheme, and that the program is expected to extend to rideshare drivers soon. That is important, because high-mileage rideshare use can make traditional depreciation even steeper, and guaranteed residuals could be very attractive to that segment, increasing Tesla's penetration in commercial and quasi-commercial fleets. The Model Y, priced from the mid-50,000s Australian dollars up to around 89,000 for the performance variant, was the best-selling car in Australia in June, achieving the strongest monthly sales since the heyday of the Holden Commodore in the early 2000s. Tesla also introduced a 6-seat Model YL earlier in the year, which is described as a strong seller. Combined with rising fuel prices and improved EV affordability, this finance innovation could sustain Tesla's strong momentum in Australia. For investors, there is of course a trade-off. Guaranteed future value programs shift some residual value risk from the customer to Tesla and its finance partners. If used EV values drop more than expected, the company could face higher costs to dispose of or remarket returned vehicles. However, if Tesla manages its price strategy carefully, continues to improve software and hardware to keep cars desirable, and maintains strong demand for used Teslas, these programs can actually stabilize sales and reduce volatility in unit demand. According to VRT NWS in Belgium, as well as reporting from LUVF, Tesla's full self-driving supervised system, often referred to simply as FSD, has been officially allowed on public roads across Flanders, even though the region's own mobility department raised serious concerns about the timing and completeness of testing. This development is highly relevant to Tesla's autonomous driving roadmap and to regulatory sentiment in Europe. The Flemish mobility minister, Annick de Ritter, announced in June that Tesla's FSD supervised system could be used on all Belgian roads, after only a short pilot period of testing in Flanders. The system is classified as a Level 2 driver assistance technology, meaning the car can steer, stay in its lane, and change lanes, but the human driver must remain attentive at all times, keep hands ready on the wheel, and be ready to intervene. In public statements, de Ritter argued that such systems can improve road safety by driving defensively and reacting more consistently than human drivers in certain scenarios. She pointed to data from the Netherlands, where Tesla reports that with FSD engaged there are significantly fewer accidents per distance traveled compared with human-only driving. However, documents obtained by local media show that the Flemish Department of Mobility and Public Works, which reports to the same minister, had issued a cautious advisory opinion. That internal analysis indicated that FSD had notable difficulties correctly interpreting some Belgian traffic signs, additional sub-signs, lane markings, and infrastructure like railroad crossings during tests. In several cases, those issues reportedly led to rule violations or situations that required the human driver to take over. The advisory also warned about a behavioral risk. As the system handles more aspects of driving, the human driver's role can drift from active participant to passive supervisor. This can reduce situational awareness and slow reaction times when a sudden takeover is needed, especially if the driver overestimates the system's true capabilities. On top of that, officials criticize Tesla's so-called offset function, which allows drivers to set the vehicle to exceed posted speed limits by a certain margin. From a regulatory perspective, that clashes with the principle that automated driving systems should strictly obey traffic rules and help improve compliance, not make it easier to overspeed. LUVF reports that the Flemish administration also found gaps in the test regime itself. Some scenarios were simply not encountered in the limited trial runs, which only covered a few thousand kilometers locally. That means certain edge cases and real-world behaviors like complex intersections, unusual signage, or rare traffic patterns were not fully validated in Belgian conditions. Despite these cautions, the minister proceeded with a broad authorization. Adding to the controversy, the minister's office has confirmed that there has already been at least one accident involving a Tesla running FSD in Flanders. The incident reportedly involved a low-speed collision at a roundabout, where the human driver attempted to take over control earlier than the system intended to turn, creating confusion and a minor crash with a stationary vehicle. This highlights a subtle but significant challenge. Human-machine handover points can be dangerous if the driver misjudges when and how to intervene. Autonomous mobility experts quoted in Belgian media argue that the decision to approve FSD may have been premature, suggesting political incentives to appear innovative may have overridden a more cautious, data-driven approach. Critics note that much of the safety performance data being cited comes from Tesla itself, which has an obvious interest in presenting the system in the best possible light. From an investor's point of view, this episode encapsulates both the opportunity and the risk in Tesla's autonomy strategy in Europe. On the positive side, regulatory approval in Flanders and in the Netherlands shows that some European authorities are willing to allow advanced driver assistance features on public roads under clear conditions. That can accelerate data collection, user adoption, and software improvement, which are all crucial to Tesla's long-term ambition to monetize autonomy through subscriptions and robotaxi-like services. On the downside, if accidents or high-profile incidents occur and are linked rightly or wrongly to FSD, regulators could tighten rules, impose new testing requirements, or restrict certain functionality. Moreover, tensions between internal safety advisories and political decisions may increase scrutiny on how such systems are evaluated and approved. For Tesla's brand and stock, the stakes remain high. Success in Europe could validate the company's autonomy narrative, while significant setbacks could fuel skepticism. According to Slovensk Novice in Slovenia, a Tesla Supercharger site in Ljubljana was seriously vandalized, illustrating a growing but often overlooked risk for Tesla and other EV infrastructure providers: copper theft and targeted damage to charging stations. At the Supercharger location near the Atlantis complex, vandals cut through all of the charging cables attached to the stalls, rendering the entire site unusable. Pictures shared on social media show cables severed close to the plugs, suggesting that the perpetrators were primarily interested in stealing the copper contained within the thick charging leads. Local estimates suggest that a thief might recover perhaps €20 worth of copper from a single cable, yet the cost to repair or replace the damaged infrastructure can be orders of magnitude higher. Unofficial figures mentioned in the report put the potential damage for this single incident around €10,000, once you factor in new cables, technician labor, site downtime, and any associated electrical safety checks or inspections. Beyond the direct financial hit, the bigger issue is service reliability. With the supercharger out of service, Tesla drivers in the area must detour to alternative chargers, which may be less convenient or more crowded. For investors, this type of story is a reminder that as Tesla's charging footprint grows worldwide, the company is increasingly exposed to physical security risks, vandalism, and petty crime that can degrade user experience and add operational costs. Copper theft has already been a problem for traditional utilities and rail networks. EV infrastructure is now joining that list because it concentrates valuable materials in accessible public locations. Mitigating these risks may require additional investment in monitoring, surveillance, tamper-resistant designs, and insurance, especially in high-risk areas. Each incremental layer of protection has a cost, which can impact the economics of running a fast-charging network. However, Tesla's advantage is scale. It operates one of the largest and most widely used DC fast-charging networks globally. Spreading these security and maintenance costs across millions of charging sessions may still keep per kilowatt-hour economics attractive. For users, repeated incidents like this could temporarily erode confidence in public charging reliability, particularly along key routes where alternatives are limited. On the other hand, they also underscore why integrated networks such as Tesla's with robust remote monitoring, quick dispatch, and strong brand incentives to keep uptime high may remain more reliable than fragmented third-party chargers in the long run. According to Extra Bladet in Denmark, Tesla CEO Elon Musk has once again found himself at the center of a very public feud, this time reigniting his long-running rivalry with OpenAI chief executive Sam Altman after Apple filed a lawsuit against OpenAI. The article describes a volley of personal attacks traded on Musk's social platform X, where Musk referred to Altman as a fraud and used the nickname Scam Altman, accusing him of taking deception to a new level. Altman responded by mocking Musk's focus on him, suggesting that Musk's renewed obsession is a sign that OpenAI's latest AI model, GPT 5.6 Sol, is currently the strongest in the world. Musk then fired back with further jabs, including a remark that Altman would only be welcome to visit SpaceX's planned space-based data centers if he could get permission from a probation officer, a clear attempt to paint Altman as untrustworthy. This personal mudslinging is taking place against a backdrop of intense corporate competition. Musk previously co-founded OpenAI in 2015 but later split from the organization and has since sued it, accusing the company and Altman of abandoning its non-profit mission and becoming too closely tied to big corporate interests. Musk lost an earlier round of that lawsuit but has indicated he intends to appeal. Meanwhile, Musk's own AI efforts under the XAI brand and through Tesla are ramping up. The article notes that both sides are racing to define the next era of artificial intelligence. OpenAI with GPT 5.6 Sol and Musk's ecosystem with Grok 4.5 and the AI work integrated into Tesla's autopilot, full self-driving, and Optimus projects. Apple's recent lawsuit accusing OpenAI of misusing trade secrets adds further legal complexity and public scrutiny. For Tesla investors, this feud matters less for the personal drama and more for what it reveals about Musk's strategic priorities and the competitive landscape. Musk is clearly positioning himself as a leading voice in AI, not just as an automaker or rocket builder. His efforts to challenge OpenAI and criticize its governance are part of a broader narrative that Tesla and xAI will pursue a different, perhaps more hardware-integrated and open approach to AI. These high-profile conflicts can have mixed effects. On one hand, they keep Musk, Tesla, and his AI initiatives in the headlines, which can attract talent, partners, and investor attention. On the other, the confrontational tone can alienate regulators, potential partners, or risk-averse customers, and may add to governance concerns among institutional investors who prefer a more restrained public posture from CEOs of large, systemically important companies. Given Tesla's deepening involvement in AI through custom chips like AI5, massive training clusters, autonomous driving, and robotics, Musk's credibility and relationships in the broader AI ecosystem do have material relevance. If his companies can deliver tangible, superior AI-driven products, the noise of social media feuds may be overshadowed by results. If not, critics may point to these episodes as symptoms of distraction and misaligned focus. According to Fulda Zeitung in Germany, a traffic accident involving a Tesla occurred on the B458 road between Fulda and Dippers, highlighting everyday operational risk rather than any systemic issue with Tesla vehicles themselves. In the incident, a Ram pickup truck driven by a 55-year-old man failed to stop in time and collided with a Seat Ibiza that was slowing due to traffic. The impact pushed the Seat into the rear of a Tesla driven by a 53-year-old woman. Police reports indicate that the driver of the Seat and his passenger suffered minor injuries, while the Tesla driver and the Ram driver were not injured. All three vehicles sustained damage, with the Seat reportedly considered a total loss. The total property damage has been estimated around €14,000, with the largest share borne by the Seat. The road was briefly closed for accident investigation and towing. There is no indication that Tesla's systems played any active role in causing the accident. Rather, the Tesla was the front vehicle in a chain reaction rear-end collision triggered by the Ram pickup's failure to brake adequately. From an investor and enthusiast perspective, this type of news is relevant only to the extent that repeated minor mentions of Tesla in accident reports can shape public perception. As Tesla's fleet grows, especially in Europe where Model Y and Model 3 are increasingly common, simple exposure means the brand will appear more often in everyday news stories even where it has no special causal role. Over time, what matters is the statistical safety record of Tesla vehicles versus the broader fleet, something the company regularly highlights in its reports. One isolated crash where a Tesla is an innocent participant in a traffic chain reaction is not material to that big picture. Thank you for listening to Tesla Daily News. If you enjoyed today's episode, please consider subscribing and sharing it with fellow Tesla enthusiasts and investors.